probably take some notes too. Okay. So, good morning, Caesar. How you doing, man?
Morning, Sean. Doing fantastic here at the office on a Sunday morning. I couldn't ask for anything more. What about you? All good?
Oh yeah, just got the exercise in, and now time to work the mind. I
Perfect,
actually
man.
wanted to come in and chat with you. Man, I'm starting to have clients that might be looking to get some help with annuities and different other things to help them out with retirement. So I just wanted to take some
Mhm.
time to chat with you and learn a little bit about that. That's an area for me that's a little bit newer. So
So, annuities are fairly simple to understand, and normally we tend to complicate these things. Really, what it is, it's essentially a savings account with an insurance company. So, there are there are variations. You have what we call fixed annuities, and then we have what's called variable annuities. So you can think of those two as a fixed annuity is where there is certain guarantees, and the variable annuity is typically you will need a Series 67 license and an investment license because those are actually the funds are actually kept in the market, or some of the funds are kept in the market. So that's where those differ. So we're only going to be talking about fixed annuities. Now, within the fixed annuity realm, you have annuities that guarantee a certain amount of rate of return, and those are truly fixed, multi-year fixed annuities. So they will say for this period of time, we will guarantee this amount of interest rate. Essentially, think of it as a CD with a bank. You know how when you go into a bank, they'll say, hey, this is a 1 year CD and it's going to guarantee you this much interest. Same thing with a multi year guaranteed fixed annuity. It'll tell you, hey, listen, typically the years are 2 to 3 years minimum. Normally we see 3 years minimum. So that means that the money's going to stay in there for 3 years. So when you have these type of annuities, they'll say, hey, listen, we're going to, right now the rates are around 5 to 5.5%. So they'll say, hey, we're going to guarantee the rate for 3 years. No matter what happens, you're going to get your 5%. And the nice thing about annuities, especially the fixed annuities, is many of them, not all of them, but many companies are going to allow you to dig in to a portion of your funds without a penalty. Typically, that's going to be either the interest rate that you're earning, or it's going to be a percentage. Normally, it's about 10%. So, for example, there's one of the Athene products, it's the max rate 3 or 5. Those are going to be multi-year guaranteed fixed annuities. The way that product specifically works is they'll guarantee the rate of return for those 3 or 5 years. So let's say you're doing a 3 year account, you're going to put in the money in there 3 years, and you're going to have penalty free withdrawals of up to the interest rate amount. So in this case, let's say it's 5%. You're going to be able to draft or draw 5% once you have earned the money, of course. So, like, let's say that you start the account and after 2 months you want to take some of the money out, then you're able to take 5% since when you started in that first year. Then that second year it resets again. So for example, you're able to take it monthly if you want it, the interest, without a penalty. So that's going to be, it's called a free withdrawal amount. The 5% is your free withdrawal amount.
now, does every policy have a free withdrawal amount, or can they be structured
No,
differently?
no, most of them do, but like I said, most of them are going to have at least the interest as a free withdrawal without incurring a penalty, and then some of them are going to be like a 10% free withdrawal amount. So that just depends on the company. So that's one thing that you look at, because obviously that might be important to the client. There's going to be some clients who say, "Hey, I'm not going to touch the money." That's great, but then things do come up, and there might be some
As a
clients where
client, maybe I might ask, well, why would I even bother with this over a CD?
Oh, because the rates of return are typically better under annuities than under CDs. Also, many of the CDs, for example, let's say you're trying to go and into the bank and you're trying to do a 3 year CD, the interest rate might be lower than on a 6 month or a 1 year CD. For example, like some of the banks right now, their 3 year CD might be at a 3.5% or 4%, right? Whereas an annuity, it's going to be 5.5%. So that's number one. Number two, generally the banks are not going to allow you to do any type of free withdrawal at all.
Right. I've never even heard of that from
Yeah, they're
any
not
sort of
gonna.
savings or
You
CD or
yeah,
anything like that.
you can't withdraw any money on a CD without incurring a penalty.
Mm, okay.
So yeah, and then as far as so that's a couple of the things. So again, you got the free withdrawal amount, allows you some access to your cash, which is nice, and then you have typically a better return than at a bank. So those are the main items there, as well as a sense of security. So CD will banks will tell you that it's safe because you have that FDIC guarantee. There's something similar with insurance companies. However, we're not allowed to mention that to the clients. But essentially, if you are with an A-rated company, it's very difficult for anything to happen with that company in terms of financially. So you're pretty secure when it comes to putting your money into an annuity, as it is. So just always make sure the company is A-rated company. Stay away from any B or C companies, even though they might offer a better return, obviously because you're taking more risk. But if you're with an A-rated company that's solid, they will generally have great customer service and they will generally be very competitive when it comes to the rate of return. So
Okay.
as the first type of annuity, and there's some annuities that are more geared towards locking the money in there. So essentially on the fixed annuities, it also depends on the company. So for example, on this max rate product that we're talking about with Athene,
Theme.
once the once you have satisfied the period of time, let's say you keep the money in there for 3 years, then after that you can still keep the money in there and the rate of return is going to be based on the market, on essentially it's like the whatever the market is at that time. The what I mean by the market rate is just essentially what a competitive rate of return. They're gonna declare the rate yearly based on the environment. So like if rates go down, obviously your rate is gonna go down. If they go up, it might be higher as well. There's always a guaranteed rate of return in these types of annuities. So they'll say, hey, the rate never can be lower than 1%, 2%, 3, whatever it is, right? But they're gonna try to be competitive so you don't move your money out of there. And then at that point, specifically with this product, not every product, but with this product under Athene, you're able to kind of use it more as a savings account once the period is up. And then the other thing is it's tax deferred. So that's another thing when it comes to annuities versus CDs. You do not pay taxes in that same year. You pay taxes until you withdraw the money. So it's tax deferred rather than having to pay taxes upfront when you make the return. So that adds to your compounding effect when it comes to the interest, especially if you're planning to keep the product or the money in there for a while. So that's another, I guess you could say, uh, a better way of doing things. I would say than putting it in a CD. But yeah, definitely, definitely something a better option in my opinion. So essentially, the only caveat I will say is there's products that will lock your money in again. So for example, let's say you have different insurance companies. Some companies will say, "Hey, if you have 30 days to take the money out, And of the annuity, if you don't take it out, they're gonna lock it up again for another 3 years or 5 years. So you do have
So they're
to.
going to renew that contract.
They're gonna renew that contract, and then it's gonna be subject to surrender charges again. So I've seen that happen. So for example, FNG has their Platinum Series annuities, which are also fixed annuities with a guaranteed rate of return. But if you do not take the money out, they're gonna renew that contract again and be subject to surrender costs at the end of that period or at the beginning of the period again. So you either have to take it out and pay the taxes on your gains, or you just it renews automatically for the next 3 to 5 years, however long your period is. So that's something you kind of have to know about and watch out for, because if it renews, then you have to wait another period of time, or else you would incur a surrender charge if the client tries to take it out again.
Wow. Let me just so I if I'm understanding correctly. So generally you'll and then this is I know we've maybe just been focusing on fixed or a multi-year,
Yeah.
but you so you say let's say you enter a multi-year guaranteed, so it has a fixed rate for a set amount of years. It's whether it be
Hmm.
3 or 5. You've got that 3-year period that you're in the contract, and depending on the company or depending on the product, you might have access to either the interest that you're earning or 10% of the amount that you've put into the quote unquote savings account, right?
Hmm.
And then specifically with the Athene, after that period, it's sort of working like a savings account in that they're giving you now a live rate based on the current market conditions. Oh, and then but you don't have that. You're no longer restricted, right? You can at least essentially do what you may want to as if it were in a savings account, right?
Exactly. Yeah. There's
Hmm.
no more restrictions. There's no surrender costs. So you can take your money out as you please.
Okay. How does the conversation even come up to discuss a product like this?
Well, you either you generally, or I generally just say, hey, listen, I got access to, if you know anybody who has any funds in the banks that are not doing anything. As you know, many of the banks on their savings still offer like a 0.01, 0.02, whatever percent, right? So I always just say, hey, listen, if you have any funds sitting around that you're not doing nothing with, we have certain products that guarantee a rate of return that are safe, and I'm here to help. That's pretty much it. And then once they might start asking about the rate of return, hey, what's the rate? Well, right now it's 5 point whatever percent. And so we start going into the rabbit hole. I don't even mention the word annuity, right? Because many people, number one, they don't know what an annuity is, and number two, some people, or at some point I will mention it, but some people might think an annuity is just a way to lock up your money. So for example, most of the annuities back in the day were were places where you would put your funds in, and you no longer have access to the lump sum. They would annuitize the contract. So those are called um, SPIAs, single premium immediate annuities, or single premium deferred annuities. And essentially the way those work is you put in a lump sum of money, and you get a guaranteed income stream for either a period of time, or for the rest of your life. And the amount that you get depends on the options that you choose. It's kind of like a pension, really. For example, on a SPIA, a single period immediate annuity, let's say you dump in $100,000, then they might say, hey, listen, if you want to get money for the rest of your life, you can get, uh, you know, $700 a month, or 650, or whatever, right? And that's going to be the rate of return is going to be based on the your age, because they're going to base it off of the average mortality of an individual of your age, whether you're male or female. And it doesn't matter how long you live, you're going to get the same amount regardless. So you could live to 120, and they will still be sending you a check. Obviously, the longer you live, the better the rate of return for you, right? But then there's going to be options whether, for example, on those you have what's called a period certain amount. So like generally you can make it 10 years. So that just means that if you die before the 10 years, you leave a beneficiary and they continue to get the income stream for the remainder of the 10 years. So let's say you're in year 5, then whomever you left behind is going to get it for the remaining 5
5
years.
more years.
Once the 10 years are up, then if you die, that's it. Nobody gets anything, right? And so that's kind of how the SPIAs work. You can also, if you want more money, you can just don't have a period certain. You just dump in the money and you're essentially taking a gamble of like, hey, something does happen. Nobody's, the insurance company is going to get to keep the funds, right? And if nothing happens, obviously you're getting a way higher amount than if you chose a period certain amount. So generally, period certain amounts are going to either be 10 years, 5 years. I believe those are like the most common ones, 5, 7, or 10 years. And then you also get to decide like, give me the stream of income for 20 years, or give me the stream of income for the rest of my life, or 5 years. So I've done streams of income for people for 5 years. I've done streams of income for people for 10 years and 20 years. So generally, especially when the interest rate environment wasn't that great, we would do that. And I mean, they could expect somewhere in the 3 to 4%, and that was when interest rates were like at an all-time low. Now, obviously, with the interest rate environment, people might see a little bit better of a return in in a SPIA or one of these products. But those are a little bit, I would say, a little bit of a harder pill to swallow, just because people, a lot of them don't want to lose access to the overall funds that they put in. So like if they're putting in 100,000, then they're losing access to the 100,000. They're just gonna get that stream of income
Mm-hmm.
for however many years
And
they
at
uh
the end of that
they
period,
got it.
do they still have that basis that they can either put into a new contract, or how
What
does
what
that
do you
work?
mean? I'm not following you.
Uh, okay. So if let's say they did a SPIA with 100,000, and so they're getting income based on, roughly the interest that they're earning, something like that,
No.
or
So you're getting your principal plus interest until it's gone, right? So let's say you do a 10-year contract.
oh,
You're
okay,
gonna get you're gonna get 10 years worth of payments, and then once the 10 years are up, you no longer have any payments. They won't you won't get any
you've
more money because
exhausted the
yeah,
funds, and okay, and earned all the
yeah,
interest all over 10 years.
yeah. So for
Okay,
example, let's say you put in 100,000, so you're gonna end up getting 110, 115,000 once the period is gone, if that makes sense.
got it. Are there any tax advantages to that
Mhm.
income?
I if yeah, obviously, if let's say that the whole amount was sitting in a IRA or a 401k. If you go the SPIA route, then obviously you're just paying taxes on the reduced amount on whatever your payment is, rather than on the whole amount. Let's say you were to take out $100,000 from an IRA, then you would pay a hundred. You would pay taxes on 100,000. Obviously, people most people don't do that because of the tax consequences. But you could do a SPIA and then guarantee the payment for however many years the person wants it, and they get this monthly, you could say, like a pension, right?
Okay.
With
Mm,
any annuity too, you're always able to annuitize a contract. So like whether it's a fixed annuity, you always have that option regardless of what year you are. So remember, we talked about fixed annuities, and we said that you have to wait for the, let's say you have a 3-year annuity, fixed annuity. So
okay.
generally, to take out funds, you have to wait the 3 years, right? To take out 100% of the funds, or more than the free withdrawal amount.
Okay.
Okay, but you can always annuitize a contract regardless of what year you are in. So that's another benefit that you could get. And they're going to base it off of whatever's in the account. So that's that's sorry, hold on. So
Uh
I'm
huh.
getting fine. So you can always annuitize the contract at any period of time. Like even if you're 1 year in, you can annuitize it, and they're just gonna use whatever money's in the account at that time, and they'll annuitize it for the period, certain amount, or however many years you want to annuitize it for. So you
And
always have that option
and what does
in
that
most
mean to
of the annuity
annuitize it?
contracts. I'm sorry.
And what does that mean when you annuitize
So
within?
you take a stream of income and you tie up the principal.
Okay.
Hmm.
So at any okay, so let's say you're in a multi-year guaranteed, but in the second year maybe you decide you want a stream of income, you can annuitize that contract.
Right, exactly.
Got it. Okay.
Yes. Bingo. The
What
last type
about
of,
Oh, go
go
ahead.
ahead.
Just real quick, I'm just between maybe those two examples. Um, it sounds like when like for with a SPIA for instance, single premium
Mhm.
immediate annuity, it sounds like that's more garnered towards or focused on generating income. What if your goal is not to necessarily? I mean, obviously you're getting more than you put in,
Mhm.
through the payments, through the income, and through the interest. But what if your goal is to grow that investment or grow that initial basis rather than to get it as income?
So the fixed annuity would do that.
Okay,
The
you would go that
the
route.
multi-year guaranteed annuity would do that, but then you also have what I was going to talk about next, which is the indexed annuity, which is all the rage right now. So indexed annuities are essentially the same, similar to a multi-year guaranteed annuity, but they will have, so like you put in you put in a lump sum of money into the annuity, and so you're gonna have different options within the annuity. There's gonna be different strategies that you can use to grow the money. So, for example, let's say that, so the money is never invested in the market, but you will use, or the return is going to be based on the market, because it's going to reflect what the market does. For example, in an indexed annuity, the money that you put in, let's say you have 100,000, and you have different strategies. Let's say you have the S&P 500, which is the most common strategy. So the day that you put the money in the annuity and you choose, let's say you choose because there's the S&P 500, there's also going to be a fixed return. The fixed return might say, hey, we're going to give you a 3.5% rate of return if you put the money in the fixed account. You have that option, or you could put it into the S&P 500 account, and let's say the day that you start, the S&P is at 3,000 points, right? That the day that you start the account, it's at 3,000 points, and you decide to put it into the S&P uh, strategy. Then 1 year later, if the account is up to, let's say it went up to 3,500, the S&P, that same day on the following year, then there's going to be a rate of return associated with that, and you're gonna get the upside potential. So what's the percentage that it went up if it goes from 3,000 to 3,500?
I think that
Roughly
was like 18%.
18%. Okay. So
Mm-hmm.
normally in an indexed annuity, there's gonna be a floor and a cap. The floor is gonna be zero typically, and the cap is gonna be, right now they're hovering right around 8 to 12%. So let's say that your cap is 10%. then from the 18% that was gained, you are going to get 10%. And the remainder, then the insurance company, I guess that's what they would keep, because they're purchasing call options. So if the call option is obviously greater, then they get to keep the remainder. If the call option is lower, then you will not earn a return, but your money will just stay the same. So if there was $100,000 in the account and the S&P went from 3,000 to 2,900, then there was no return. Therefore, you have no return, but you didn't lose anything. The only thing you lost is what you foregone, what you could have gotten if you would have put it into the fixed return account, which, let's say in our example, was 3.5%. So you did lose 3.5%. You just didn't. Obviously, it's not gonna, you're not gonna see that because your account's still gonna be at 100,000. It just didn't go up 3.5%, right? Or it didn't go up at all. It just stayed the same, which is nice, gives you that sense of security. So let's say that the market really goes to hell in a handbasket that year, then you're gonna be sitting there and breathing easily because your money is still worth the same. If the market goes bonkers and it goes great, then at least you got a 10% rate of return, which is not bad, right? So that is, so essentially the way it looks is every time there's a good year, your money goes up, and then when there's a bad year, your money just stays the same, and it's like a ladder. It's like a staircase essentially. It either goes up or it stays the same. And that's how index annuities generally work. There's a lot of variations in the strategies, and I don't want to get into those too much because it gets really confusing. But essentially, that is the way the index annuities work. They also have a free withdrawal amount typically, and it's gonna vary by company. And then you also are able to annuitize these contracts. And actually, I probably should, even though it's complicated, let's get into the annuitization portion of it. So generally, the accounts do not have any fees. So annuities typically do not have fees because they have surrender costs. So the surrender costs are the amounts that if you take more than the free withdrawal amount, you pay a penalty. Those are the surrender costs. Now, if you're trying to annuitize a contract, there's going to be some of your index annuities that will offer you a guaranteed income, like a guaranteed income rider. What that means is that they're going to base your income amount not on your actual cash value or on your principal amount or on whatever's in the account. They're going to base it off of a different account that's going to be growing at a guaranteed rate of return. For example, let's say that you started out with $100,000 in the account. Year five, let's say there's 120,000, right? But you added a guaranteed rider or a guaranteed income rider to your annuity. And sometimes the riders are named differently, but if you add that rider, essentially it means that you're going to pay maybe a 0.5% or a 1% amount to add this rider. So that means that if whenever you have a year that you don't make any money, that rider is going to be charged from there. So your annuity amount could actually go down because you're paying for this rider, right? But what that rider is going to do for you is you have your you have your principal amount or what's in the account that's been growing or not growing, and then you have the other amount that's your guaranteed income amount, and that guaranteed income amount is gonna grow no matter what. So, for example, let's say that they're gonna guarantee that account is gonna grow by 6 or 7 or 8% every year. Then, no matter what, that 6% is gonna be compounding on that amount. And let's say that after year five, your guaranteed income account amount is, instead of 120, where it was your actual, that's your actual cash value, your guaranteed income account might be 135, 140, right? Because it's growing guaranteed at a rate of return that they stipulate when you add the rider. So if you want to annuitize the contract, they're not going to base it off of the principal amount. They're going to base it off of the guaranteed income amount, which is going to be more, right? So let's say it is more and they base it off of that, then your payment amount per month is going to obviously be better under those circumstances. And so they're going to use that account amount to determine your monthly amount that you're going to get, if that makes sense. I know it's a little complicated, but
Sure. Maybe just to understand that a bit better, is that completely different than having um like a fixed account portion or like a guaranteed portion and having an index portion in your one annuity product? Or is that the way that that would be possible, is by doing that guaranteed income rider?
I'm not sure I understand your question.
Oh,
Can you
because
rephrase it?
yeah. So I'm aware that there's ways to set up, for instance, an index annuity, but you might set a portion of it that you want to be in one strategy, for instance, like a fixed, like the fixed guaranteed amount, and you might want, maybe you say 50%, and fifty
Mhm.
percent you want it to be
I,
in the
I
S and
I
P
got your
500.
question.
Uh huh.
I know what you're asking. So, it has nothing to do with the fixed account. So the the guaranteed income amount, it's just it starts off with the amount that you put into the contract. So if it was $100,000, it's gonna start off from there. And if you did add that rider to it, it's gonna go up at whatever percentage is stipulated, no matter what. Like it's always gonna go up. And sometimes they'll say, "Hey, we'll give you a bonus of 10% or 20% on this side of the equation." So that's just like I wouldn't say arbitrary number, but it's just a number that you know that it's gonna be there. So a lot of times annuities will, like they will advertise, or companies will advertise, "Hey, we're going to give you a 10 or 15% bonus," and they're talking about the bonus on the guaranteed income rider account because they're charging for it a percentage, but they will, make good on that promise, but only for the amount that's going to be used to annuitize a contract, if that makes sense. Not on They won't give you the bonus on the actual cash value or on the money that's actually in the account. I know it's without any visuals, it's a little bit harder to understand, but
Let me see if this example is fitting that, and if that makes sense. So, okay, taking an example, say you have 100,000, and well, okay, one question: can you add the rider at a later date, or like after the first year, or you're setting up the rider when you're setting up the annuity?
you're setting up the rider when you're setting up the annuity, and
Okay.
they'll tell you, "Hey, this is going to be your percentage that you're going to earn on this money, and you are going to earn a bonus as well." Or there's also going to be products that have the rider included, and they're gonna charge you no matter what. So it's already gonna be embedded in there, whether you want it or not. And then there's gonna be products that you're able to add the rider to it if you wanted to add it.
And that guaranteed income rider, that can be set for the whole amount of the that you've put into the annuity, or a portion of it,
No,
or
it's always set for the full amount.
okay,
Hmm.
got it. And
Yeah.
so that rider is basically taking that basis, say it's 100,000, and what it's doing is it's guaranteeing this amount of growth every year, but at the same time it's charging basic. There's a cost to the rider, so maybe it's a
Yes.
half a percent. Um, so that half percent can actually affect the basis, but the rider amount is basically growing each year. And so,
Mhm.
how does that? I guess I'm trying to ask this simply, but how does that work, or how does that interact with, say, the annuity growing normally? Like, so you have the rider, but then you have other stuff growing.
Yeah, so the two amounts, the one that's gonna the guaranteed income rider amount has nothing to do with the cash value amount. I mean, they just use the cash value to charge you for the rider, if that makes sense, like the your 0.5% or your 1%, right? But it's more like an arbitrary number, you could say, because what if you never exercise that guaranteed income rider amount, right? But
Oh.
like if you're gonna add it to it, it's probably because you're probably gonna exercise it, right?
Oh, okay. So nothing is okay. So it's technically it's growing in
Hmm.
potential, but
In
nothing is
potential, yeah.
happening until you decide to annuitize.
Right, because they're gonna base it off of that larger amount.
Got it.
Yeah,
Okay.
yeah. So it's not
So the
real. You
annuity
could
is
say.
basically doing what it would normally do, however you set it up,
Hmm.
but with this rider, if it, you're setting up the main point of this rider is you're setting up because you think in the future before the annuities contract completes, you're gonna want to set up income, and that guaranteed income rider increases the income that you would potentially be gaining.
Exactly, bingo. That's exactly what it does. So it's
Okay.
you could say it's like a phantom amount that's in there, right? It's a phantom account value, you could say, because if you do exercise it, normally what happens is they're using the actual account value to fund, obviously, the annuitization, right? And then once that account value is gone, because it doesn't matter because they still have to pay you out until if you do a guaranteed income for life, then they're gonna pay you out until you pass away, right?
Okay.
But yeah,
And,
I mean,
and one more time, I had it before, but just so I write it down, the definition to annuitize.
annuitized, it's a guaranteed period or guaranteed income for a specified period of time, whether it be a lifetime or a number of years that you decide. But in this specific example where you have that guaranteed income rider, it's gonna be for the rest of your life that you're gonna annuitize typically.
Okay. Got it.
I'm
Okay,
not
so
100%
to
sure on.
annuitize,
Yeah,
okay, so to annuitize is to basically change the structure of this contract so that you're now having an income for however however the annuity might be structured, the remainder of the 10 years of the contract, or in this guaranteed income example, structure it so that you have income for the rest of your life.
exactly. And then you are locking the money up, so you can no longer take like different amounts from the contract because you already annuitized it. So essentially, annuitization, you just locked it up, and they're gonna give you a stream of income for whatever years you decide to take it.
Got it. Okay.
Mhm.
Last question. I guess between setting up an annuity and setting up a life product, assuming someone can
Mhm.
qualify for a life insurance product, um, are there different situations where you'd still want to go with the annuity over, say, like a single premium
Yeah,
life insurance?
I would say if they're older,
Mm,
if they're older and they have a bunch of money, because obviously with an annuity you do not have the cost of insurance, right?
fair point. Okay.
Yeah, so there's no cost of insurance. Your money's gonna grow, so you can run an illustration and it'll show you like, hey, if you put in $100,000 here or $100,000 there, what's gonna give you a better rate of return? It's gonna be the annuity. But if you are looking for it for the purposes of, I guess, legacy and leaving something behind, then obviously you can't beat life insurance because that's gonna obviously have a greater rate of return for whomever stays behind.
Excellent. Okay.
Yeah, and then
Any
Sometimes also depending on the years, then it might be worth it, because on the life insurance you can get tax-free income through policy loans, right? Whereas on the annuity, you will have to pay taxes. So, if it's not much of a difference, then the life insurance might be superior in that regard, where you're taking, the money tax-free.
Got it. Okay. Those are some really strong points to close on. Any final thoughts to wrap us up, Caesar?
I think we complicated it enough.
Yeah. Oh man, that was even sending my mind through some loops, but no, that was some really good information to get into. Really appreciate it, Caesar.
Yeah, no problem. I just getting another phone call, but anywho, let's connect again sometime, and maybe we can go through them a little bit slower, one by one, and do different segments rather than, like, this just this overall review where we get into three different types. Because again, like I said, it's not easy to understand. For me, it was simple when I read it. I mean, I kind of understood it. There's still gonna be some strategies within, like, the indexed annuity that I still have issues wrapping my head around, but I understand them. But it's because every company calls it a different name sometimes for on the strategies. It makes it a little more confusing.
Ah, I got you.
Yeah,
Okay.
yeah,
Okay.
they all have different names for the same thing.
I know. That makes it even more fun. All right.
Yeah.
Awesome. Thank you so much, Caesar. Appreciate it.
All right, Sean.
Uh-huh.
Thank you.